Hi, my name is Steve Bick. I'm a portfolio manager, chartered financial analyst, certified management accountant, and certified insolvency and restructuring analyst. And this session we're going to talk about portfolio management in the global context. Now let's think about the globe and all of the markets around the globe for a second. In total, the market cap is about $25 trillion, or it was back in 2001. I actually don't have a figure for you what it is this year. But of that $25 trillion, the US made up about half. So that leaves about $12.5 trillion of market cap that is outside of the USA. So the way to diversify is relatively easy. You can move it into Europe, Japan. Those are probably the largest markets. Of course, we've got China that's emerging really quickly. And I would imagine in the next decade, you'll probably see them move into a really large part of the international portfolio arena. So what we're going to look at today are the benefits and the ways you can diversify a portfolio into the international market. So let's take a look and see what the case for international diversification is. The first thing that international diversification can offer you is low international correlations. In other words, when the United States market is going up, maybe other markets aren't doing quite as well, and vice versa. So if you have a little bit of a dip in the US markets, you can always, take your portfolio and maybe diversify into one of the international markets or a basket of international markets, and that might offset some of the behavior of the US market. The next case for international diversification is the higher expected returns. Typically, in diversifying into an international market, particularly if you're looking at maybe the emerging markets, as portfolio theory goes, the higher the risk, the higher the return. So if you're looking at an international diversification, the returns are expected to be higher, mainly because of the increased risk and exposure to your portfolio. But normally this is more than offset by the lack of correlation with the US market. And then finally, we're going to look at trends to barriers. The barriers to entry into any kind of international market in the past were really high. And there seem to be trends towards lowering those barriers, and we'll discuss that in more detail a little bit later. So let's dig into the correlation between international and US markets. And a lot of that lack of correlation, of course, has to do with movements in currency. But I think in most cases, the currency moves are manageable. We can typically hedge those away. So let's just dig straight into the correlation effect just of the markets themselves. And what we have here is a chart. We've got expected returns and the risk of the investment. And really what this is a risk-return trade-off, the domestic investments versus an internationally diversified portfolio. And what you can see here, the black line we have here is the domestic portfolio, and this is the efficiency frontier or efficient portfolio. And this is at A is going to be the efficient portfolio. The efficient frontier, of course, is the line over here, the black line. And by adding an international component to the portfolio, we can see that the efficient frontier actually moves outwards. And what that does by this efficiency frontier moving outwards is that you can either move from A to B. In other words, you're getting the same expected return, but for a lower level of risk. Or you can have the same level of risk and move your portfolio to C and increase your return exponentially. So the case for international investments and the reduction in correlation between the US and an international portfolio, you can see the benefit, and the benefit really is the fact that we're able to move the efficient frontier outwards and therefore either get the same return for lower risk or a higher return for the same amount of risk. So the benefits are there from a correlation standpoint. So really what we're looking at with the low correlation is that there's independence. In other words, Japanese stocks are independent of US stocks. So the fact that a US stock market goes down really doesn't have any impact on the Japanese market or the European market or whatever. So that's the first criteria that we're looking at. Let's have a look at an example of the correlations between just the stocks. And we're going to have a look at these both hedged and unhedged. Now, when we're talking about hedged, that means that we've taken the currency risk and we've hedged it away. Okay? Unhedged is we just take a dollar investment, put it into, let's say, a pound investment or a pound stock, and we let the investment move. Obviously, the stock itself will move, but also we leave it exposed to currency moves. When we hedge away that currency exposure, we would expect that there's a slightly different result. So let's just have a look firstly at the stocks. Down the left-hand side here, we have the countries. So we've got, and these are US correlations, so US to Canada, US to the United Kingdom, US to Japan, to the European market, to the world, and then to the emerging markets. Now the first column here is going to just be based on just the stock return. All right, so the correlations with the Canada stocks versus US stocks is 0.7, relatively high. Of course, we would actually expect that the Canadian stocks would actually be higher than a higher correlation with US stocks. They're just across the border. A lot of what happens in US will be reflected pretty quickly into the Canadian stock market. Not all the time, because there'll be some localized stock movements there, but a lot of it is captured, so hence the 70% correlation with the US. UK as well is a 66% correlation, or 0.66, with the US, and as you can see, the EU is relatively high. Japan, however, is dropped to about a 40% correlation with the US. The world, you can see, is the highest at 86%. Now, why would the world be 86%? Well, that's obvious. You've got half of the world stock market is made up just of the US, so you would expect a relatively high correlation, particularly when we just looked at Europe and Canada as well, being high correlations to the US. We would expect that to be relatively high because you've got 50% of the global portfolio tracking the US or being one. So to try and push that down would be relatively difficult. And then the emerging markets have a low correlation, as we would expect. When we move down to the second column and we're going to try and take away the currency exposures, Canada barely moves from 70% to 69%. Britain goes down a little bit, 3 points. Japan barely moves, about 1 point. The European community barely moves. The world, of course, doesn't move, and the emerging markets don't move either. Now, this is relatively surprising just because we would expect that the currency moves would really have a big impact on these investments. But what this is showing us is that there's really not a hedge benefit to taking out the movements in the currency. Now, one thing to remember, of course, is that these currency hedges can either be short-term or long-term. And what they're showing, or what has been proven, and specifically in this exhibit, is that over the long term, there's really no benefit to taking away the currency hedges, or to hedging the currencies. Over the short term, however, if you want a tactical type allocation, then maybe there is a benefit just for a specific trade. But we'll dig into that deeper a little bit later in the session. Now let's move down to the next column, and this is bonds. And first we have bonds unhedged, and then we have bonds that have been, the currencies have been hedged away. You can see the Canadian bond market has a 50% correlation with the US. It's about the same for the UK. Japan correlation is incredibly small at 0.17, and Europe at 0.19 is also very, very tiny. When we come back and we take out the currencies, we hedge the currency moves away, Canada jumps right back up almost in line with stocks. The UK, or Britain, actually jumps up a little bit, but not too much. Japan really doesn't move at all, and this is in contrast to US stock market. Of course, that doesn't change because there is no currency hedge. So what you can see here is that as a correlation to stocks, US stocks, there's a very low correlation on the international arena. And once again, Japan's providing an incredibly low correlation with the US. So really what we're saying here is bonds, there's a little bit more of a benefit to hedging away the movements in the currencies. And now we've really got to think, why is that? Well, of course, currency moves are typically tied in with interest rates, or that's one of the things that drives currency moves. So when you have a currency that's maybe coming down and there's some kind of a targeted rate of return, Japan would be a classic example. Their economy is really based on exports, So they like to keep the yen relatively weak, or within a band of about 110 to 120 yen to the dollar.